everyone. Thank you so much for tuning in to the Setter Capital Family Office webinar. Hope that you are doing well. And while we wait for people to trickle in, I'm going to share a screen. I'm not sure if you're able to. Let me just take a look. Okay, here we go. We're still sorting things out with the platform, but hopefully you're all on. And I'm going to share screen just to walk us through a couple of fronts. Okay, and just a couple of housekeeping rules. All right, we're going to wait for other people to trickle in, but if you can turn off your camera so we don't hear any background noise for all the attendees that are with us today, thank you again so much for joining us. Feel free to type your questions either in the chat box. There's also a Q&A box, so you can burning questions for our guest speakers, who are absolutely phenomenal today, by the way. It really bring in a lot of knowledge and a lot of market expertise. So you're in for a really, really good hour. Thanks for spending the time with us. And then we'll answer all the Q&A questions right near the tail end of the webinar. But of course, we're always happy to follow up with any questions you may have. So not to worry, we'll try to answer as many as we can, okay? For today, it's really going to be a jam-packed hour, actually, and you'll get to meet all the fabulous speakers that we have today. We're going to do a very brief run through the family office survey that Setter conducted, and we'll jump into what the current state of the secondary market looks like. Some of the transaction structures, we'll take an in-depth dive into that. Some of the transaction pricing that we've been seeing in the market, as well as specifics for family offices in the secondary market. And hopefully, we will still have time to dive into the future outlook for what secondaries are expected to look like in 2026 and beyond. Okay, so that's our goal for today. Hopefully, we can make it happen. And without further ado, I'd love to dive into our speakers today. First up, we have Sean Ruman. He is on the VC secondaries team at Setter Capital, sits in Toronto. He's executed asset sales, fund restructurings, bespoke liquidity solutions for investors, companies, and GPs. He began his career at Chartwell REIT and Banco Azteca, building a very strong base in transaction management and investment strategy. Sean holds a Master of Science in Management from Ivy Business School and a BA in Accounting from Western University. Hey, Sean.
Hey, everyone. How's it going? Thanks for tuning in here.
Awesome. Well, we can't wait to hear from you. Next up, we have James Bradshaw, the Vice President at Kline Hill Partners, who is heading up their recently opened London office. Very, very exciting. And James, we're super glad to have you here. I know you specialized in a lot of the LP secondary transactions since joining the firm at Kline Hill in 2019. And as I already mentioned, you've been appointed to lead the London office team. So we'll see a lot more out of European activity. And prior to joining Kline Hill, James was a manager in Deloitte's UK M&A Transaction Services Group, conducting financial due diligence for private equity and corporate clients across a range of industries. Hey, James.
Hey, Kristina. Thank you. Great to be here.
Yeah, awesome. We're super excited to have you. All right, our next panel, who brings a lot of expertise, particularly from a legal perspective, and I'm glad that we have this perspective on the episode today as well. We have Elizabeth Tabas Carson, who's a partner in the global finance team or practice at Sidley in New York. And Elizabeth represents alternative lenders, investors, asset managers, hedge funds, traditional banks, you name it, financial sponsors and their portfolio companies on a very wide range of complex domestic and cross-border leverage finance and special sits transactions. She has extensive experience in structuring and negotiating private financing, secured and unsecured lending transactions, cash flow, asset-based leverage facilities, M&A financing, mezz and second lien financing. The list goes on. We're going to actually leave the contact information for the speakers today, so you're able to get in touch with them and have all your questions answered, even if we don't get to it this webinar. Hi, Liz.
Hi, thank you for having me.
No, we're super excited to have you on. We have such an awesome, esteemed list of panelists. And of course, joining her is Oren Gertner, partner of investment funds practice at Sidley. in New York, but also overlapping with London. So maybe James and Oren can go for a coffee when you're there in London sometime. And Oren's practice includes structuring and offering of domestic and international private equity funds, hedge funds, and other alternative investment funds, such as debt, real estate, buyout, energy, distressed, fund to fund, etc. The list goes on. He represents institutional investors in connection with their investments in leading private equity, private investment funds, real estate funds, credit, secondaries, and co-invests, and has worked on the organization and implementation of funds, sponsors, and term arrangements, carry plans, and a variety of transaction matters related to private funds. So we're super, super happy, Oren, to have you and your expertise on. Welcome.
Thank you. I'm happy to be here.
Excellent, excellent. All right. And then last but not least, Josh Biderman. He is the head of business development at SecondaryLink out of Toronto, where he leads sales and partnerships for the market intelligence platform specializing in secondaries and liquidity strategies. If you guys have not yet checked out SecondaryLink, make sure you do so. There's a ton of information and news on the secondary market, which is incredibly insightful. And he works closely with secondary funds, advisors, asset managers, LPs, law firms to deliver key market intelligence streams. As I mentioned, secondary pricing data, historic transaction databases, evergreen fund investments, and he'll talk a lot more on that front. So we can't wait to hear from him. Welcome, Josh.
Thank you so much. Excited to be here and appreciate you putting this together.
Excellent, excellent. And then just a little bit about me. I'm the Senior VP of LP Advisory at Setter Capital. I've been here for about 12 years, executing a variety of different transaction types, whether it be full portfolio sales, single asset sales, structured deals, etc. So I also host the Women of Secondaries podcast on SecondaryLink. So if you are a fan of podcasts, tune in, and that's a great resource as well. But that's enough about me, and I'm really, really excited to welcome all of our panelists today. And I think what we wanted to start with is a briefer of the survey that we did, surveying over 3,000 family offices, different sizes, alternative allocations, various geographic location, and various secondary market activity levels. And some of the stats that we've seen were awesome, actually. They're very, very interesting. And we're happy to send you both this graphic as well as a copy of the full survey after the webinar. It's no problem at all. But I'll highlight some of the major points that we've seen, which is, from the buy side, there are still about 80% of family offices who we've seen do not purchase company shares or secondary market or participate in the secondary market on the buy side. But 13% are very closely monitoring the market, and about 7% are actively purchasing. Now, keep in mind, this is coming from a very large subset and showing an increase in activity over time. For fund secondaries, there is about 47% who are not currently purchasing, while 27% plan to purchase and currently do purchase, and about 14% that are monitoring the market. Okay? In terms of some of the factors that are driving secondary purchase price decisions, 50% of their decisions to buy are the quality of the assets, and about almost 30% is the discount and purchase price. So those were really two of the main dominant factors. And there was about 67% of family offices that cited they saw an increase in the number of opportunities offered in the market. So a very, very big stat where, over half of the respondents received their deal flow from brokers. And actually about 38% of respondents relied on brokers for about 75% of their deal flow. So happy to know that we play a role. And about 80% of respondents, suggested that they don't receive a lot of deal flow from platforms yet. It's still a growing area, and I think a very rapidly growing area, but there was about less than 10% of deal flow received from platforms, and under 10% of deal flow received from sellers directly. So I would say to this end, brokers continue to be the dominant source of deal flow, while family offices remain cautious and maybe approaching it themselves directly, right? In terms of sell side, we saw about 27-30% monitoring the market and about 60% not yet selling or considering selling. And those that are considering selling, some of their prime motivations for considering a sale, more than 50%, 54% exactly, was liquidity based. that's as to reasons why they would consider sales. 36% was tied to portfolio allocation and rebalancing in the market, and about 27% was to crystallize some of the gain. So as you see, there's a very wide variety of reasons for why some of the family offices are monitoring the market for potential sales. And this was an interesting stat, actually. 40% saw an increase in GPs considering GP-led secondaries for those that are invested in LP stakes. So, which I'm not surprised. I think we'll talk about volume quite a bit on this podcast. But that's high level stats. I'm happy to go into a lot more of them, but one last one that I'll leave you with is 78% of family offices expect distributions to increase in 2026 from their fund commitments, and about half expect pricing in the market to stay the same. So we're going to talk about all of that and more very shortly. So I won't take all the attention with the family office highlights, but I would love to jump into the current state of the secondary market. And Josh, maybe jumping over to you to just share some, high-level details on what you're seeing from a data standpoint from SecondaryLink, maybe perhaps volume, types of players in the market, et cetera.
Yeah, absolutely. And thanks for the introduction there. And at a high level, I feel like it's important to sort of set the stage in terms of where we are today and how that relates to historic kind of market volume and activity. This probably comes as no news to anybody, but we are in the midst of what is a record and headline year for secondaries as a whole. And actually, if we were to look back at last year was also a record year, and this we are currently on pace to significantly surpass that. So let's dig into some of those numbers and sort of set the stage for where we are today. Last year, depending on the advisor sort of estimate, consensus was somewhere around $160 billion in total transaction volume across LP-leds, GP-leds, and directs. At least roughly around that 160 number. And then here in 2025 in H1 alone, looking at the different estimates, it's anywhere from about 100 billion to 110 billion in transaction volume in just the first half of the year. And actually from a Center report earlier this year, only 3% of surveyed respondents expected lower volume in H2 relative to H1. So I think it's fair to say from a volume perspective, we're very likely trending towards somewhere around 200 billion plus. Which obviously would be a substantial, more than 25% increase relative to last year's record. And beyond the, I guess, high-level sort of top-down volume, we're pretty much seeing all observable metrics are going up and to the right in this current market. Just to highlight a few, North America, in terms of thinking about the transaction split geographically, North America continues to dominate with about 60% of LP-led volume and about 65% of GP-led volume, at least through H1 of this year. Western Europe maintains the second largest share of volume in each of those segments with about 15 to 20% of LP-leds and about 35% of GP-led volume, and the rest being split mostly across Asia and the Middle East. And in terms of what's really driving this volume, one of the significant things we're seeing, especially over the last year and really 2 years, is continued pricing strength. So buyout continues to price strong in sort of the mid-high 80s, even into the low 90s. Infrastructure, low mid-90s as well. And then one of the biggest changes that we're seeing is credit is now one of the strongest pricing strategies consistently, at least through H1 this year. Consensus estimate was around low mid-90s. Venture has also had a significant recovery from a few years ago back, I guess, post-COVID, and rebounding. We're seeing pricing in higher quality portfolios in sort of the mid-70s, high 70s even. And this is the biggest increase, at least for a single strategy so far in 2025. Real estate continues to sort of lag behind the other strategies, but we've also seen increased pricing strength in that vertical at around an average of 70% from different estimates, at least through this part of this year. So overall, we're seeing, as I said, a significant growth and definitely on track for a headline year, with the expectation that pricing strength and other factors that I'm sure the other folks are going to discuss today are driving that.
Awesome. No, thanks, Josh. That was very comprehensive. And James, I'd love to also get your take on, being a very active buy-side firm in the secondary market across a numerous flow of different deal structures. For specifically LP volume, what types of deals are you most prominently seeing? Is there a particular industry vertical, vintage, size of deals, size of funds, et cetera, that you can speak to?
Yeah, sure. So as Josh mentioned, like definitely it's going to be a record year. We've certainly seen that as a buyer. In terms of the LP side, so call that $100 billion market, roughly 50% of the total secondary market. Because it's so large, there are a lot of intricacies and nuances within that. So there's really a lot of ways that you can play that as a buyer or as a seller. In terms of the split from vintages, typically what we've seen is kind of that recent vintage bucket of 2019 through to 2024. It's around a third of volume. You also have a pretty active kind of what I'd call mid-vintage bucket, so 2016 through to 2019 vintages. These are typically funds that you would expect to be harvesting quite heavily and distributing back. And against the backdrop of kind of a challenging exit environment still, that has driven quite a lot of volume for that specific bucket. So that's around what we've seen, around a third of volume. And then what I would characterize as the legacy tail end positions, 2015, kind of 10 plus years older. That's around the other third. So it's difficult to track by industry. I think buyers definitely are still being quite defensive in terms of what they're buying. They are paying up predominantly for quality, where they have confidence in the GP's marks and the GP's path to liquidity and an exit. So yeah, a lot of different ways that you can play the market, and it's super active across the vintages, across industries.
And just you mentioned an interesting point, right, with the newer vintages coming up more frequently in the secondary market. What would you say is driving that? Because I think a lot of people are used to seeing sort of tail end funds or maybe mid vintage funds be sold. What do you think is driving the higher unfunded sales?
Yeah, I think it predominantly comes down to the cash flow dynamic. So the LP community typically is used to receiving back more dollars than they would have to pay in. And over the past few years, a lot of LPs and allocators haven't seen that. And so they have a lot of this unfunded commitment, obligations to pay in capital. And for a lot of groups who are looking either to rebalance or to manage their cash flows specifically, they are looking to get rid of some of that unfunded, the recent vintage. And some secondary buyers like that. Others, will price that in accordingly, and maybe the price will come down. But kind of depends on what side of the fence you fall on, whether you like the current vintage and deployment time, or if you still think rates are still quite high and maybe it's not going to be the best vintage. But yeah, I think overall it's still the cash flow dynamic we're seeing driving quite a lot of interest for the recent vintage stuff.
Yeah. And I think also what's interesting too is there's been so many more new entrants that are specializing in different sectors of kind of LP stakes, right? Like you see head of sort of common fund secondaries, Carrie, branched out to run set up her own secondary shop. I think some of the heads of mantras have also, ventured out on their own. And so you're starting to see these specialized shops that will either focus on the tail end of the market or the newer end of the market or the small end of the market, right? And it's just with the entrance of new players, I'm sure we're going to see that drive past 200 and beyond in terms of volume. So I agree with that. Sean, taking it over to you for a bit, as you specialize in the venture secondaries landscape, if we shift gears towards maybe more direct venture secondary transactions, which are gaining momentum like no tomorrow, are there any industry verticals or sectors you're seeing most activity in? Any types of most prominent types of deals, geographic location of those deals?
Yeah, I mean, I think just by nature of sort of the venture market in general, a lot of the core activity gets based out of sort of the US, just sort of, where a lot of these companies set up. What we're really seeing more of, rather than sort of the companies themselves who are transacting, but a greater activity of European family offices getting active sort of in the North American venture side. A lot of them are trying to get access to, some of these more sought after names. I think what ends up happening is a lot of them have fund stakes in North American managers. These North American managers have strong performing portfolio assets within them, so they sort of stick out to these European family offices and European buyers. And then in addition to that, I think, again, just circling back to the nature of venture capital in general, there's lesser activity abroad in that space. I think there's lesser opportunity for growth, lesser opportunity for exits than what you find generally in North America. So in terms of sort of, geographies and verticals, it sort of sticks in around that. But in terms of the types of deals that we're transacting, direct venture secondaries is still the most sought after purchase and transaction, and likely, a vast majority of our volume. What we are seeing a greater activity or greater interest in, and I'm sure we'll dive into it deeper, is purchases and transactions conducted or facilitated via special purpose vehicles. So investors get indirect access to these sought after companies. Again, I think it has to do sort of with dynamics around difficulty of obtaining access for international players to North American companies, especially as they get into the later stages.
Got it. And Josh, I'll turn to you on this because I may be biased, but looking at the growth of our of the Sutter VC secondaries team, I think that's one of the next frontiers of growth for secondary market trends. Are you seeing that more news around the venture landscape or more players entering that space as well for sort of direct secondary deals?
Yeah, I think we're observing really a lot of different trends in and around the venture sort of ecosystem, and I think, I mean, the timing of this particular webinar actually happened to work out pretty great. That over the last couple of weeks, there's been essentially three pretty significant M&A events that have been announced specifically in venture secondaries. One was the acquisition of Industry Ventures there by Goldman Sachs. They purchased mostly stakes in venture funds rather than underlying companies, but of course have a pretty well-established universe of all the underlying holdings. We also just saw over the last 24 hours, Charles Schwab just announced that they're acquiring, or at least intending to acquire, Forge Global, which is essentially like an established marketplace or online kind of trading platform for venture directs. And then earlier we also saw EquityZen get acquired by Morgan Stanley Private Wealth. So that's a lot of sort of large established players, especially those that have some kind of private wealth angle that are looking to get more into venture secondaries. And I think that's really reflective of the types of participants that, as Sean mentioned, are now increasingly getting active in the space, those who want exposure to these very highly valued private companies, the OpenAIs, the SpaceXs of the world, where so much of the market cap growth is currently happening in privates, that from whether it's the wealth segment, family offices, or however you want to divide it, I think we're seeing a lot of new entrants. And further, just to try and measure some of the output of that, or the way it might be changing the market, is there's obviously a lot of conversation these days in terms of the exit environment, and specifically in venture, just the backlog of necessary exits in terms of these late stage private companies. But over the last year or so, we've actually seen that through secondary trading and structured tender offer rounds at a lot of these late stage companies, we're actually seeing a higher volume of liquidity coming through that mechanism and through secondaries than through traditional IPOs. And that's even accounting for the fact that IPOs, at least in North America, have rebounded a little bit. So I don't think it can be really understated that we're at a very significant transition point when it comes to venture secondaries. And I think the expectation is that a lot more people from the wealth segment and otherwise are going to continue to look for access to these companies and to participate in that growth. And lots of the largest sort of established institutions are taking note and making their move, whether that's a spin out or an acquisition or another strategy that way. So I think it's definitely an interesting time.
No, thanks for that background. And staying on the venture directs topic for a moment, Sean, I'd love for you to maybe elaborate, because look, some of the audience members here have maybe done secondary deals, others haven't. And so what are the typical transaction types? You've mentioned them briefly, but maybe going into a little bit more depth about, SPV deals, et cetera, and how are they nuanced? And Elizabeth, from a legal perspective, I'd love to get your take as to what are some of the inherent risks in these transactions, right? And what are some of the things that people should be mindful of when they're evaluating, okay, is this a transaction that makes sense for me or not? So, Sean, maybe you want to start, and then Elizabeth can sort of follow suit.
Yeah, sure. I think the main one, and sort of the biggest one and the most popular one, is a direct secondary, in which a direct shareholder of a company will sell shares directly to a buyer of these shares. This is facilitated directly through the company. So there's an actual transfer of ownership that occurs on the company's ledger. I think that's the cleanest and most direct structure. From there, it starts to get a bit nuanced. So the second most frequent transaction type we see is via an SPV, where, for a variety of reasons, maybe direct transfer is not possible, or it's just not something that's being, evaluated or worked on right now. But a buyer would essentially access shares or get allocation of ownership into a company via a structure in which the buyer will essentially become an LP in this single asset vehicle, and that vehicle itself will sit on the cap table. And then the final third structure type that we see is something called a forward. It's a forward contract agreement in which the seller may not be able to sell the shares directly to a buyer today for whatever reason. They will agree to a transaction price and transaction structure today. The seller will essentially receive the funds for their stake or for their ownership in the company today, but the actual transfer of ownership of shares to the buyer will occur at some sort of later date. It's usually defined as a liquidity event, so an IPO or an acquisition. But again, that varies, and the structure of those can get pretty complex as well.
Got it. No, that's helpful. And Elizabeth, I'm sure you see a lot of things happening across all those spectrums, but would love to hear from your experience. What are some of the risks?
Yeah, so we'll start with like the direct structure. Obviously, like, taking a direct interest in a private company, probably of all those transactions, is the most sort of time consuming because you can negotiate it, you can step in. But the benefit is like in private company interest, if you're the owner of record, most of them require it. And so just sort of the case law around private companies is, it's pick your partner. So if you're not the lender of record, you don't have those rights directly. And, when we come at it from the financing side, if you don't have those rights and something happens, you may not be in the position you think you are. This sort of, I would say, in between one is the SPV. It has no other liabilities. You're not taking the credit risk on the other person in the same way. But sometimes in the SPV structures, to the extent you're the only person in the SPV, maybe not an issue. But if it's pooled, you're also sort of, if there's large unfundeds, you're sort of taking credit risk on those other investors as well coming in. So that's something you might want to understand what's happening. You may want to make sure cash flows are always running to that entity. You sort of have to think about the cost of doing things, how your voting works. And so there's different things that go on. But one thing that is nice about having the sort of SPV structures as people start to think about leverage and maybe also the risk and recourse coming back to them, having the SPV being able to lever those assets and this sort of a larger interest and pooled, you may be able to get leverage on the assets, although you're kind of taking credit risk on the other investors. So I think there's sort of, pros and cons to all three, but you could think of it as the repo, you're sort of the most you need to understand who your seller is because you're still taking direct risk on them, where the other two have kind of transferred into the new entity where you actually are the direct owner.
Got it. And do you see any transactions come across your desk that are more sort of forwards that people are asking you to verify and protect to the extent possible?
I think we do as a group. I mean, I think a lot of times it's also sort of people's own tax planning, which may drive structure and sort of the consents that they can get. I think a lot of the deals that we do right now, and Oren might be able to speak better to this, but I think a lot of the stuff we do, people call us and they say, so these are my goals, and we kind of just craft something for them, and it might be fast, it might be safe. It's really investor specific rather than, there's one form we're going to use it. Because even when we start with a transfer form or something like that, those end up being super negotiated. So I think that's sort of the state of the market right now.
Yeah, I always said that, sometimes the lawyers would be the ones that drive the creative structures because they're trying to find ways around making something happen that's tough to make happen. That's helpful. And I guess, James, from your side, if we, and Oren, I'd love to get your take on this as well. When we're looking at, the traditional LP secondary deal, stepping away a little bit from the VC direct space, and, there's obviously the cash transaction and everybody can sort of sell, close at quarter end and get paid. But we've started to see a rise of sort of preferred equity deals being more commonplace. Deferred deals continue to be very a likely tool to sort of bridge the bid and ask spread. What have you seen from your side, and what do you find is sort of the main counterparty risk, maybe some return implications? How do they differ? What should one think about when they're considering either a pref or a deferred payment structure? And then, Oren, from your experience with all these transactions, whether it be a portfolio deal or sort of single asset deal, what are just some of the risks with the different transactions, and what should people be on the lookout for?
Yeah, maybe taking the pref equity piece first. So as a buyer, occasionally we'll look at these types of structures. From our perspective, they can offer potentially a little bit of downside protection if you're giving or trading away some of that upside. And so we have started to see a lot of creative structures. They do require a little bit more work on the execution side. Doesn't always make sense for every deal, and especially smaller transactions, but there certainly are ways that you can minimize risk for all parties in terms of the counterparty risk and setting it up properly. So yeah, it doesn't work every time, but certainly we are starting to see ways to create kind of win-win scenarios for buyers and sellers. With regards to the deferred solution, ultimately it's just another form of leverage for a buyer. And so typically a buyer would factor in 6, 7, 8% cost of capital on that deferred piece. That's essentially because it's the same cost of capital if a secondary fund was using their own capital call line or NAV facility or something. So it tends to get you to the same place. From a seller's perspective, there is a little bit of credit risk, but I mean, if you're dealing with a large institutional secondary fund with billions of dollars of AUM, you're backed by blue chip LPs, like there really isn't that much credit risk. We're going to make the payment. We have LPs that are on the hook to pay in capital, and we have various other sources of funding. So I get it. Sometimes people might view that as having some uncomfortable amount of credit risk, but it's really, really small. And we don't see that getting in the way of transactions. And sometimes that can just help you bridge to a slightly better optical price. Maybe it's a couple of pennies, 3 pennies, but it gets you to like 80 cents or 90 cents. And sometimes that's just enough psychologically. So it can be an interesting tool. And some groups use that more than other groups.
Yeah, no, we definitely see it play out in practice pretty much, on every transaction that we execute, we see it at least being considered. Oren, anything to add from your side about in terms like the counterparty risk, but then also maybe other provisions that are, applicable to deferred payments or preferred equity structures that are not present in cash deals?
Sure. So I guess on the deferred, I would say if you do it correctly, under the right circumstances, it absolutely can be a win-win situation. As James is saying, the headline of the purchase price can actually be very critical from the seller perspective. Some of them, can be more institutional, and it's very important, the headline price. So being able to increase the purchase price, and sometimes it can be significant, then can be a really useful tool from the buyer perspective. Not just it's leverage, like depending on the vintage of the portfolio, the vast majority of the second and third payment, for example, can be funded through distributions. So they basically out of pocket just for example, the first payment or some portion of the later payments. But it's very useful tool if the right vintage can basically fund most of or a big portion of the deferred. In terms of the risk, I would say I see it all over the map, because even for an institutional buyer, let's say a secondary fund, it's sometimes easy and sometimes very difficult if the seller insists on a guarantee, meaning the fund can be extremely reliable, but the seller can argue what happens if your LP defaults. So even if it's a big fund, it really depends on the organization, but the parent company is not always willing to say, yeah, I'm going to back my fund, because If it's a public company, there are issues. If it's a bank, there are even more issues. If it's an insurance company, there's a lot of issues. And even if it's privately owned, then the founders say, well, we're not backing up our own funds from our own money. So every organization think about it differently. In some cases, we have been very successfully negotiating somebody to back up the purchase price. In others, we face those issues. And then if you want to mitigate any risk, literally, the finance people on the call would know better than me, but we've seen anything from very light guarantees to like a full sweep of the bank account, creating an SPV through which distribution are being held. They actually interest in the SPV are secured for the benefit of the deferred. You can make it as complex as you want or as simple as you want. And really, it depends on the risk tolerance of the seller and the appetite of the parties to really kind of make the deal more complex.
And I was going to say, as we start to see people take leverage in those structures, a lot of times the structuring around that and the cash control is really driven, I said, by if there's a lender, are they sitting in the SPV? Are you having direction letters that go to the SPV's accounts? And some of the, and do they have voting rights? Depending on if it's a bank versus a private fund, you might find that, in that pref structure, a person that can hold sort of a de minimis interest might have voting rights in those structures. And so you see a lot of, again, hyper sort of customization to who our investors are and to kind of keep continued alignment between the sort of all the parties is the idea.
Yeah, so in some way, I guess the transactions are getting simpler, but in another way, as the market develops and kind of as more creative structures come into play, it could also get more complex, as Oren mentioned, depending on how complex you want to make it. So.
Yeah, exactly, and what your drivers are, and if
Yeah.
you're funded or not, like where your funding is coming from.
So just as an example, we speak about pref equity deal, we speak about deferred. There are, we just closed a pref equity deal with a deferred payment. So you can add components, make deals more complex.
Yeah, no, we've seen those as well, and they're difficult to align on, but when they align, they work well. Well, taking a step back a little bit, and Josh gave us a briefer on pricing, right? In terms of just prevalent market pricing, James, I'll turn this over to you, given that you're often on the buy side and modeling out these funds, and I'm guessing underlying assets as well, of course. How has the recent sort of macro geopolitical environment, economic environment impacted your underwriting of funds, of assets as a general?
Yeah, it's definitely created just more discipline within the industry. In terms of activity and volume, it tracks, I'd say, relatively closely the public market. So when you see your big headline that come out from certain politicians, that certainly can cause a bit of pullback in public markets. And then we've seen actually very quickly markets recover. And it's quite similar on the secondary LP side as well. Some deals can get put on pause, but your buyers, especially the large funds that are really driving the volume and moving the needle, they do have to deploy, and there is a lot of opportunity out there. So very quickly we've seen that bounce back. Your pricing is definitely disciplined. I think depending on the strategy, whether it's large cap, mid market, or small buyouts, it can range from kind of 5 to 15, maybe 20% discount. There is definitely a lot of funds out there that just aren't transacting. So there's definitely that flight to quality. For every fund that trades at 90 cents, probably multiple more that would probably price at 60 cents, 70 cents, and there's just a bid-ask spread and a transaction doesn't happen. So discounts certainly had widened a few years ago, kind of post 2022. We've definitely seen a pretty strong and robust recovery. And as mentioned before, it really just comes down to confidence in the GP and the quality and also the path to liquidity. There's a lot of exit processes happening right now. If you read through quarterly reports of certain buyout funds, lots of companies are up for sale, but hasn't really been a huge rebound. Q3 of this year, we start to see a little bit more activity in IPOs for the right size company and scale. That those are obviously happening as well. So yeah, overall, like a lot of price discipline on the VC side specifically. I thought a lot of the topic is still obviously around AI, and that's driving a lot of volume. And I think people seemingly are kind of putting the macro and geopolitical landscape aside, and you're making bets and following the momentum around certain companies. And that's not specific to secondaries. That is, you're right across private markets. So if you think about the average or median Series A valuation for an AI company now, it's almost $100 million. That's 3 times higher than it was several years ago, and that's just translating into more value and more secondary activity, also kind of on the VC side as well.
Yeah, and I completely agree with your comment around, the buyout fund pricing. Although it's probably still the strongest asset class that we also see on our side. It's more proportion of funds pricing in, let's say, the 90s or 95 area, but it's not like sort of 2021 times when you saw par premium pricing for a lot of the buyout funds, and particularly pre-COVID as well. There was a lot more funds pricing in sort of premium territory, at least for buyout. I think we're still yet to get there. On infrastructure is probably more of the asset class that we do see more stability. And as you mentioned, some of the political drivers are probably less impactful unless it's U.S. renewables and infrastructure, but a little bit less impactful, and they have a little bit more longer term. So I agree. We're definitely seeing that proliferate, and venture can. Venture, what we've seen on our side too, is it can be the widest ranging pricing asset class, right? You can have something pricing at 10 cents on the dollar and something pricing at 85 cents on the dollar, and they're both venture, and just depends on the quality that you PV assets as well. So, that's probably the most volatile asset class. And Sean, would love to get your take as well, just in terms of, sectors or anything else you'd like to add in terms of pricing for VC direct deals.
Yeah, for sure. Happy to. Sort of as James alluded, AI is definitely a driving factor in pricing, and one that we've seen the greatest volatility in over the last year, mainly upward. For context, I was looking through SecondaryLink pricing. In 2023, for example, AI, the average discount was around a 35% discount to the last round valuation. Today, that number is a 30% premium over the last round valuation. So, a growth of over 60%. AI adjacent verticals are also feeling the impact. One that sort of comes to mind indirectly is something like space and defense. I think we're seeing through, companies like Anduril, an integration of AI into defense. And so we're seeing strong pricing there as well. 2023 average discount was 15%. 2025 defense and space is around a 20% premium to the last round. And then, in general, artificial intelligence sort of remained the most dominant vertical on our Setter 30 or quarterly report of the most sought after companies, and now represents 2/3 of the Setter 30. So 20 of the 30 companies. Last quarter was 17. The year before that, it was, I think, closer to 14, 15. And it's driving a general soar in valuation. This quarter, the average last round valuation of the Setter 30 was 68.4 billion, which is up over 33% from Q2 and up over 90% from a year ago. It was, largely propelled by major up rounds from tender valuations and tender rounds from companies like Anthropic, OpenAI, Grok, Crusoe, etc. But sort of on the flip side of the coin, a lot of verticals have also remained flat in terms of pricing over the last year or so, which sort of from a holistic point of view is, basically in line with them, going down in value. So stuff like fintech, although it had a blip maybe around like 8 months ago, I think people were optimistic about the IPO market for fintech. It had a jump where it was pricing a little bit stronger, but it's still from 2 years ago trading at around a 40 to 50% discount. And crypto as well. I think there's 1 or 2 companies in the space that jump out as strong actors that have seen rapid valuation climb. But most of them are still trading also at around 50 to 40% discount to the last round.
Excellent. Well, no, that's very comprehensive. And I think, for anybody who has more specific questions around particular asset classes, all of Obviously, James and Sean would be happy to connect, myself would be happy to connect to discuss transaction-specific prices because they do tend to vary quite a bit. Jumping over to just some of the specifics to family offices when it comes to the secondary market. Josh, maybe real quick over to you. Has there been an increase that you've noticed in pricing monitoring? Because you offer a lot of pricing data on SecondaryLink where people can come in and sort of monitor their portfolios. Would love to see if you've actually seen an uptick in visits to that tool of people starting to monitor their portfolios.
Yeah, so absolutely is the short answer. Like, I think to almost summarize the biggest change, at least that I've seen personally over the last 2.5, 3 years, in engaging with family offices directly is really proactivity. Like, I think initially a lot of it was just wanting to sort of passively monitor the market, keep up with news, want to know what new GPs might be coming to space, and now a lot of family offices are actually coming to us looking to level the informational edge a little bit that they feel maybe is preventing them from engaging more proactively on secondaries, and at the very least, regardless of if they have an urgent liquidity need or are interested in even buying, they're wanting to better understand just the price for the holdings that they currently are invested in. And so I think the days of sort of investing in a portfolio of funds and leaving it and just sort of leaving it to the side and waiting to get the cash back, I think those days are over. And I think at the very least, folks want to be monitoring much more proactively. And we've even seen some groups, like I was just speaking with a Middle Eastern family office last week, that they came to us because their entire goal for the next year is to actually start buying individual LP stakes in some of their own existing positions. And the pricing data obviously was one of the pieces of the puzzle that they were looking for. The other big change that I would say in terms of proactivity is now with the emergence of all the different evergreen structures that have come to market, almost all of the secondary managers, it feels like, have one or likely will have one in the future. And so in thinking about proactivity, they're also trying to understand historically, maybe we've only allocated to closed-end funds and what other characteristics do these products offer in terms of the fees, the liquidity mechanisms, the types of deals that they invest in. So those are really the two biggest, I guess, changes in terms of the information that they're seeking when they come to us. And I think it can be succinctly sort of summarized just as being more proactive.
Yeah, no, that's I know I use SecondaryLink quite regularly for just gut checking on things as well. And Sean, from when you're dealing with family offices, whether they're sellers in the market or whether they're buyers in the market, are there particular aspects that are very important to them when they are entering the secondary market?
For direct deals, it's obviously just sort of the quality of the asset, the underlying asset they'll be purchasing. When it comes to more nuanced things like structured transactions via SPV, I think, and it's sort of been alluded to already, but the quality of the managers that they're investing into, they want to know that the capital that they're investing indirectly into an asset is in good hands under a quality manager, a reputable one that's not going to dissolve in the short term, or one that may not, run off with their money. So, I think that's sort of the biggest things that they look for. And then, with quality managers comes just general transparency into the ownership structure and, what they can expect going forward at distribution or at exit, et cetera. So I think that's sort of the biggest things that they turn to.
Got it. Yeah, and I think on the LP side, I guess when we're working with family offices, what we've observed as well is they do tend to be very much more asset focused, right? So it's either specific to a particular company or a particular fund, whereas a pension or let's say an insurance company will be a lot more programmatic with their sale. It's a broader portfolio construction conversation, whereas I find a lot of the family offices, they're either getting out of an asset class completely, or they're focused on performance and trying to mitigate risk in a particular asset. And then I think also anonymity in operating in the market, it probably tops the list, at least from what we've seen. And so I think with more pricing data on platforms such as SecondaryLink, with sort of discrete broker processes as well, it's helping family offices enter the market at a more informed view, and just I think greater transparency in the market around pricing, around the deals that are getting done. It probably is helping to drive volume activity from the family offices. But Elizabeth and Oren, over to you guys real quick, and I do want to leave some time, of course, for the Q&A section. But from particularly to family office clients, are there best practices that people should keep in mind when they're looking to mitigate risk, whether it's ahead of tapping the market or during conversation with buyers or sellers in the market? What are the sort of best practices they should keep in mind when approaching the secondary market?
Yeah, Liz, happy to take it first. I would say a couple of points. Like historically, we've seen family office more on the sell side. Roughly speaking, our practice, I would say, we would say about, if you count also wealth management, about 10% of family office on the sell side. We do see more and more appetite for family office to be on the buy side. I think one of the challenges that we see, especially in an LP portfolio, is many of them are very, very, very large. And they may only be interested in some of them, but it's not quite choose and pick type of thing by the time the deal has already been cooked. And one of the disadvantages a family office might have against an institutional investor is that for a large secondary fund, when they come into this deal, they are very proud to check the box. I'm already in this fund. I'm already in this fund. I'm already in this fund. I'm not in this fund, but I have relationship with a sponsor with another fund. So it's very easy for them to run the process with, even if it's like 100 different GPs, it's a very smooth process for them. For a family office that may only have just a handful of hits with those relationships, it is more intimidating or time consuming for them. Obviously, the other challenge, again, depending on the size of the family office, is the amount of K1 you should anticipate to get at the end of the year. Diversity is a good thing, but if you're going to get 100 K1, you need to make sure that you can actually process them and be able to do it. I feel kind of, maybe I'm touching on the future, but as we see GP-led starting to attract more family office, that can be actually a good solution. And I would say, historically or a few years ago, there was maybe just like 1, 2, 3 deals a year that are over $1 billion. Now there's a few a year that are over 2 and 3. 1 billion is not an exception anymore. And, you may ask me, why am I talking about the large deals for family office? Because I think that's actually where the opportunity is. Those large deals typically would have a syndicate process at the end. And I feel that's where family office can come in. And, the deal has already been negotiated by institutional investors. They can actually move faster on that, and it's pretty concentrated. They can, due diligence the asset or the assets. It's actually might be more suitable, even though at first look, those deals are more complex, are more complicated. But once you actually get to the syndication process, that may actually be a good fit for a family office.
No, that's an interesting take. I haven't heard that before, but I agree with you. That opportunity set is quite large because they tend to be a little bit more nimble. Well, guys, would love to get to some of the questions that we have. We have one question, particularly to direct secondary deals, VC secondary deals. Indirect transactions, are you seeing more collaboration on the founders' management teams to give liquidity for early investors through secondaries?
Happy to dive in on that one. Just provide some context on that. Even for a direct, for people that are unaware, even for a direct secondary, you have to go through the management and receive, board or company approval on a direct transaction. Some companies either have it, written outright in their bylaws, or just generally have a stance where they may not approve direct secondaries unless like very particular situations, but a broad statement of not approving it. We've seen those dynamics shift over the years. Where we've seen certain companies adjust to the ongoing environment. So, 2020, 2021 in a very IPO heavy market. As companies gear up for IPOs, they typically shut down direct secondary transactions just to keep the cap tables clean. 2023, as things started to slow down on that front, companies became a bit more open to allowing early liquidity. I think then to investors, I think they understood sort of, okay, the exit horizons become a little bit more unclear now. I think, as sort of just to paint with broad strokes here, it's largely remained unchanged. I think companies that, they fluctuate in their positioning, their stance on approving direct secondaries. Certain companies will, remain firm throughout their entire life. Some of them will fluctuate, but as a whole, whatever percentage of companies were allowing versus not allowing direct secondary transactions, 5 years ago, 3 years ago, 1 year ago, and today, it's pretty much the same.
Got it. And Liz and Oren, we have one question, particularly from a legal standpoint. Could you offer some insights on how these new creative structures have affected the closing processes for deals from a legal point of view?
Well, I guess it depends on how complex the structure is, but I think sometimes it ends up taking more time than people think because the structures are complex or you're getting a bunch of consent. And people are using more leverage now. So you have not only, your equity being, unlevered, but now a lot of times your equity is levered. So I think in that way, I don't know that it necessarily, makes your sale longer, but if people want to have leverage embedded with their sale, then, to purchase it, you're going to do a whole nother set of papers that you wouldn't have done a few years ago.
Yeah, and I guess it also depends on the counterparties you're working with, right? Is it an experienced group that has done a sale or a buy side, or a company that's gone through secondaries across their shares? So it's tough to say. But one thing that we've noticed is there still is a lot more like standardization that's starting to take place in secondaries processes, right? Whether it's GPs who have sort of standard transfer agreements, or lawyers that have sort of long form agreements, right? That can help the transaction be facilitated. I think one thing we always advise when we're operating on transaction is whether you're a seller or buyer, work with an experienced secondaries lawyer, because sometimes a corporate M&A lawyer is just not maybe well positioned to understand some of the nuances that apply to secondaries. And I'd love to, maybe a quick take on what are some of those nuances that apply to secondaries that you don't see in sort of corporate M&A that, very, very high level.
Yeah,
Go ahead, Oren.
I totally agree with you. Like, concepts that may seem very neutral at the beginning without experienced, seasoned secondary lawyer can get missed. For example, there is adjustment to the purchase price in almost every secondary. It makes perfect sense from a business perspective. However, it really depends on the vintage. You really need kind of to think about it from a business perspective, and your lawyers need actually to highlight it for you, in a sense that in a late vintage, it may end up that some of the lines would end up with a negative purchase price. Like, how likely do you think it happens? Does it change your overview of the deal? What's your business goals? Is it just to achieve liquidity and certainty, or there's some upside you want to take? But without somebody to highlight this nuance for you, you can actually not realize it and kind of be actually disappointed at the end outcome, because the process can take a few months between signing and closing. Definitely between the NAV time or the cutoff date and closing can be 3 to 6 months. A lot can change, some of which you can predict pretty well. So you just need somebody to actually make you focus on those details.
Yeah, and we've seen, it's funny you mentioned negative purchase price. We have seen that in a deferred deal where, the second installment ended up being negative, but that's related to like PTP issues and some things that had to flip over to the following year. So there are nuances, and I think an experienced counsel is able to navigate. Well, guys, look, I appreciate all your time. We are at the top of the hour here, so without sort of holding everybody up, I just wanted to say a big thank you for sharing all of your insights and experience, guys. And I'm sure that we'll get questions for all of you. And whoever is interested in receiving more information on either the webinar or the recording of the webinar or contacts with our panelists, please feel free to reach out and we'd be happy to provide that. But other than that, thank you everyone. Hope this was informative and have a great rest of the week.
Thanks, Kristina. Thanks, everyone.
Thanks, everyone.
Thanks.
Cheers.